Are you a Canadian real estate investor and not sure whether you should continue investing in Canadian real estate or getting into the US market? Well, guess what? This video is going to be perfect for you. After watching this video, I'm going to break down the pros and cons of investing in Canada versus the US. It's going to be a big decision maker and a game changer in your investment portfolio. And it's all going to begin right after this. Hi everyone, I'm Josh Tavares, investor and realtor with eXp Realty. It would mean so much if you can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you're looking to invest in real estate with high cash flow, great appreciation, have the ability to scale for multiple properties at a low price point, hands-free, click the link below, let's schedule a call and get you on your way. And without further ado, everybody, let's begin. Number one, price point to entry. Now let's start off with Canadian investing. As a Canadian real estate investor, you're probably going to see property prices from, I would say, the low 200,000s all the way to the millions, depending on where you're going. Now, if you're in Ontario, you're going to pay a premium based on the economic factors that take place, especially in Southern Ontario. Purchasing rental properties in Canada can definitely cash flow, just know the right areas economically and price point wise, but I will say they tend to be more expensive than the US counterpart. The Canadian real estate investor space, it is really hard to get the 1% factor to work in your favor, which is essentially monthly rents adding up to 1% of the property price. If you can get within that range, it is a sure thing that you're going to cash flow. If it is below that, it's going to be a little bit more challenging to cash flow, and that's essentially what's taking place in the Canadian market today. With US real estate investing, there are many different markets that have excellent economic fundamentals taking place as they would in the Canadian market, where you can find for under 100,000. With it being such a low price point in many places in the US, it's fantastic. So let's say you've got about $500,000 in equity and you're going to purchase properties about 100,000 in USD. You could purchase 5 properties with such a short period of time with minimal restrictions, all in cash, let's say from a HELOC or cash you have. Where here in Canada, you would be very limited to find that. You essentially may buy 1 if you're very lucky in certain other markets, 2, but that's essentially it, and you wouldn't be able to scale to purchase 5 or so. Now, number 2, population. Now in Canada, our population is a fraction of the US, hovering around 36 million people in Canada, where in the US, you have over 250 million people. In Canada, there are less larger hubs of places like Toronto, Vancouver, and Calgary, where those are the areas that tend to have the most population, have the most growth, and tend to have the highest property appreciation and rent appreciation. Where in the US, you have over 50 states, and within each state, you're gonna have at least one hub area that's gonna have the bulk of the property appreciation, rents, jobs, economic growth, and so much more. And within the US, because there's so many hubs, you could essentially shop around to find different states that you can invest in, because there's a lot of states with a lot of economic factors working really well with really low price points, as we already listed. With Canada, there tends to be a little bit less in terms of option. Reason being is that, of course, we are a large country, but there's only so many provinces and so many cities that have strong economic factors, with the strongest region being Southern Ontario. With the difference of population, it means you're gonna have a higher room for more renters looking to get into the market. Both Canada and US have very low supply, very high demand. So as an investor, no matter where you're gonna go, it's still gonna be fantastic in terms of the amount of supply and demand. As an investor, having that work in your favor to have great tenants renting out your great properties. Now, to compare the two, if you're an investor looking to invest here in Canada, it tends to be more prudent with more rules and restrictions. Now, interest rates are lower, but there are more implications, making it more difficult for you to qualify to purchase properties here in Canada as an investor. Where in the US market, there tends to be less rules, tends to be a little bit easier in terms of restrictions, but the interest rates are rising now, so something you want to definitely look out for when purchasing properties for your cash flow. Now, if you're looking to invest in the US side and you're a Canadian, in the past there was significant barriers to entry. However, we have our own lender that works individually with foreign nationals who's able to look at both sides of the coin. The market that you're investing in, as well as the client profile of yourself as the investor, and be able to piece it all together and provide you financing up to 70 loan to value and upwards of almost 1.5 million combined total. And with how much properties are worth in some of these places, that's fantastic, because you can buy so much property for $1.5 million US. Now I will say with interest rates rising, it becomes more challenging to qualify given that we have many stress tests here in Canada, which makes it a little bit harder for investors to get into. And essentially for investors, there tends to be more restrictions than I would say for individuals looking to purchase a home for their own primary residence. Now for property management, if you're an investor who's looking to invest here in Canada, there are many different property management companies depending on the region that you're investing in that can take care of your property, and also you have the ability to drive the property and make sure that property management is taking care of your investment. Honestly, I totally agree with having about 8 to 12% of your gross rents going towards property management, because personally for us, we don't want to have to go all the way to drive for the property, to have to collect rents, deal with maintenance, find contractors. That job's already been done by property management, so why try to reinvent the wheel when we can hire someone who's done it already? Now you still have to go about managing the manager and making sure things are done properly within a good time frame. Now for many investors in the Canadian side looking to invest in the US, they may get scared and say, well, how am I going to be able to fulfill the actions of managing the property? Well, guess what? There are many great property management companies that you can work with, and we have access to one who has 450 plus units already managed, that they're able to take care of your property in a good standing for 10% of gross rents. And that's something that's fantastic, because personally, we don't want to have to drive over the border to take care of any rental concerns. We want everything to be done for us and for anything to come out of our rents versus us having to physically go on site and take time away from our family. And the property management team that we're working with has a great reputation of working with investors as well in working with tenants and making sure that both sides work in harmony. And we personally know so many investors that rather go to their property and personally manage it. If they're not able to drive to it, that's a concern. And for us, we're all about trying to find scalable rental properties that we can buy more and more properties that have more cash flow and have more appreciation and equity that we can scale and live a better life for our family. Some investors are so focused on being in their own backyard that they're going to cap themselves at about 2 to 3 properties instead of having the potential to get 20 plus properties with very creative, unique strategies. Now, as an investor who's partnering with individuals, you definitely want to invest into having a corporate structure, so then you're reducing liability in the event that something was to take place and a tenant or an entity was to try to sue you. They can only go after what you have in that specific corporation. And many investors get scared to want to invest in the US because they don't want double taxation and corporation concerns. However, with the US, with the right structure in place, working with the right cross-border specialists, which we have access to, you have the ability to only pay one tax and use credit from your US side onto your Canadian side tax return, which is fantastic and something that you want to work with a specialist, a cross-border specialist who knows exactly what they're doing on both sides, so you're not paying for double taxes and you're also represented accordingly. Now, personally, I'm not an accountant, but I highly recommend you speak with a cross-border specialist if you're looking to invest in US real estate, someone who understands the US and Canada side, so then you can go out making the right decisions to have the right corporate structure, the right tax entity, so you can go about investing and scaling your portfolio. And the next comparable we're going to look at is the banking system. Now, the banking system here in Canada is very prudent and very stable, which is fantastic in being able to acquire loans and knowing that our financial industry is in good state. However, because at times they're very prudent, it becomes harder to attain additional financing, where on the US side it'd be a little bit easier. But you definitely want to work with someone who is investment focused and has access to multiple lenders, not individuals who only have access to their own branch or their own bank's product offering. Also in the Canadian market, they're very conservative and highly regulated. Now, another comparable when looking into for Canada versus US real estate investing is the corporate structure. And I know I touched upon that already, but when going about obtaining a corporation in Canada, it's going to be substantially more expensive than the US. It costs you a couple $1,000s not only to form the corporation, but also costs you multiple thousands of dollars come tax return time, versus you could also do that and also go about independently owning it individually. However, in that regard, you're going to have a lot more liability than being under a corporation, but in Canada, it's a lot more expensive than in the US. And by being in a corporation, it becomes more challenging to get financing for the A-type lenders and have the lowest rate. Now, there are commercial lending and B lenders and so on and so forth that'll invest into the property, but there becomes more restrictions when it comes to refinancing or any type of financing involving with the property in a corporate entity. Now, on the US side, in order to create a corporation, it'll cost you a couple $100s, upwards of about $500 USD, and then it'll cost you about $300 to $400 to go about filing your tax return, which is a lot cheaper than the Canadian side, that once you're in that corporate space with your rental properties, it becomes a lot more expensive. So your cash flow definitely has to be on point on the Canadian side, where on the US side, it's a much lower cost. Another thing to look into when it comes to comparing the two is from a developer standpoint, it becomes easier to go about developing in the US market as there's less restrictions in some of the larger cities, where in Canada, places like Toronto, there are a lot more rules, a lot more regulations, and they take a lot longer to get back to you. This can lead to tens of thousands of dollars, if not hundreds of thousands of dollars more for large investors based on restrictions, based on the ability to comply, and based on time frame. The last thing you want to look into is the exchange rate. Now in the US side, the exchange rate is about $1.20 higher than in the Canadian market. So any type of costs, maintenance, insurance, anything as such is going to be X amount more expensive in terms of when you're converting it. But the funny thing is that even though from a cost dollar perspective, it is more expensive in the US in terms of conversion, but then the actual price range in the US in many counts tends to be cheaper than the Canadian side, even though the conversion rate is higher on the US side than the Canadian side. Definitely something you want to be mindful of when you're going about investing into the market, whether it's in the Canadian or in the US side. All in all, both sides are a great investment opportunity. Personally, we like now the US market, given that we've said before, the ability to scale, great cash flow, and great low price points. And we also provide a hands-free opportunity for other partners to get in and build their real estate investing portfolio, something that becomes very challenging to do here in Ontario and many parts of Canada as well. I hope the video is super helpful, insightful, and gives you all the information that you need to know about comparing investing in the US versus Canada. I'm Josh Tavares, investor and realtor at eXp Realty. It means so much if you can help us out. Hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And if you're looking to partner to invest in cash flowing properties, low price point, great appreciation, click the link below. Looking forward to getting on a call and learning a little bit more, helping you grow your portfolio. Thanks so much for watching. Take care.